Welcome to another round of Financial Insights. Today we're diving into the latest buzz in the world of economics, the Federal Reserve's recent interest rate hikes. It's no secret that the Federal Reserve has been quite active lately. They've just cranked up their benchmark interest rate for the sixth consecutive time, pushing it into the range of 3.75 to 4%. Now, this move is something of a double-edged sword. On one hand, it's going to make borrowing a bit more expensive, which might sting a little for those of us with loans or credit card debt. But on the other hand, there's a silver lining for savers. Savings accounts and certificates of deposit are starting to look a lot more attractive with increased returns. So there's a bit of give and take happening here. As we can see, these rate hikes are causing a ripple effect across the financial landscape. But what does this mean for you and me? When the Federal Reserve tweaks its interest rates, it's like knocking over the first domino in a long chain. Let's delve into what this means for different aspects of our financial life. First up, credit card rates. As the Federal Reserve hikes up its key interest rates, the cost of borrowing for banks increases. This in turn trickles down to consumers, making credit card debt, particularly variable rate debt, more expensive. With credit card rates at record highs, it might be a smart move to transfer balances to a card with a zero-rate balance transfer offering. Alternatively, considering a low fixed-rate personal loan could be another viable option. Moving on to mortgage rates. As interest rates rise, so too do mortgage rates. This can make the dream of homeownership more costly. But here's a tip. Lock in the lowest fixed rate available when buying or refinancing a home. This could save you a significant amount of money in the long run. Next, let's talk about your investment portfolio. The effects of inflation and the geopolitical outlook are significant factors to consider when investing. During times of rising interest rates, diversifying your portfolio across equities is recommended. Value stocks, especially small-cap ones, are expected to outperform. However, it's important to remember that every investment comes with its own set of risks and rewards. Lastly, the real estate market. This sector could face challenges due to higher interest and mortgage rates. Higher borrowing costs can impact both buyers and sellers, potentially slowing down the market. But remember, real estate is often about location. So, while the broader market may face challenges, there could still be pockets of opportunities. Clearly, the effects of these rate hikes are far-reaching. But why is the Federal Reserve doing this in the first place? The primary reason behind the Federal Reserve's rate hikes? Inflation. Let's get a closer look at this economic phenomenon. Inflation, the general increase in prices and fall in the purchasing value of money, has been a persistent foe in recent years. To combat this, the Federal Reserve has been raising its key interest rate. This is a tool used to curb excessive growth and keep inflation at bay. But it's not just a simple lever pull, it's a calculated move often met with mixed reactions. Various Fed officials have voiced their opinions on this matter. San Francisco Fed President Mary Daly, for instance, has indicated that the Federal Reserve will need to raise interest rates higher, and for a longer duration to address what she calls sticky inflation. She acknowledges the panic these actions have caused on both Main Street and Wall Street, as the market experiences volatile swings in response to new economic data. Similarly, Minneapolis Fed President Neil Kashkari and Atlanta Fed President Raphael Bostic have expressed the need for higher interest rates. On the other hand, Fed Governor Christopher Waller has issued a warning that interest rates could go higher than expected due to stronger than expected economic data. These statements, while varied, all point to one thing. The Federal Reserve is serious about its fight against inflation. But this doesn't come without challenges. The market's reaction to these rate hikes has been anything but calm. The uncertainty surrounding future economic data has led to volatile market swings, reflecting the precarious nature of this economic balancing act. So, what does the future hold? It's a question that's on everyone's mind. However, one thing is clear. The Federal Reserve is not backing down in its battle against inflation. It's a tricky balancing act as they navigate through the uncertainty, volatile market reactions, and the ever-present threat of inflation. The fight against inflation is a tricky balancing act, and it seems the Federal Reserve is pulling out all the stops. So, we've covered a lot of ground today, from understanding the Federal Reserve's interest rate hikes to exploring their impact on various aspects of our financial lives. Let's take a moment to recap. The Federal Reserve has been steadily raising interest rates, a move aimed at combating persistently high inflation. This upward trend in rates has a domino effect on our economy and personal finances. Higher borrowing costs mean that everything from house mortgages to credit card debt becomes more expensive. On the flip side, savers may start to see a higher return on their bank deposits and certificates of deposit. In the world of investments, the landscape is shifting too. Equities, real estate, and commodities all react differently to rate hikes, making portfolio diversification crucial. And let's not forget the Federal Reserve's ongoing battle against inflation, a complex and delicate task that influences these interest rate decisions. Remember, in the world of economics, change is the only constant. Stay informed, stay prepared, and don't forget to hit that subscribe button for more financial insights. Until next time.